Welcome back to the channel. Look, if you've ever dipped your toes into the world of finance, you've probably been hit with a tidal wave of acronyms. Index funds, ETFs, mutual funds, hedge funds. It sounds like a secret language, designed to keep regular people out, right? Well, here's the truth. These are just different vehicles, built to take your money to the same destination, wealth. But if you hop in the wrong ride, the fees might just eat your engine before you even get there. In today's deep dive, we're stripping away the jargon. I'm going to show you why 90% of retail investors fail, simply by picking the wrong vehicle. Ready? Let's get into it. What is a fund? Before we look under the hood, we need to define the machine. What exactly is a fund? Think of it like a neighborhood potluck. If you wanted to host a massive dinner party by yourself, you'd have to buy the turkey, the sides, the drinks, and the dessert. That's expensive. But in a fund, you and 1,000 other neighbors all throw 20 bucks into a hat. With that huge pile of cash, you can buy the best of everything, and everyone gets a plate. In the financial world, that plate is a diversified portfolio. You own a slice of the total pie without having to spend all day in the kitchen. Index funds, the king's first up, is the gold standard for people like Warren Buffett. The index fund. Why do we call it passive? Because an index fund isn't trying to outsmart anyone. It doesn't hire a flashy Ivy League genius to guess which stock will moon tomorrow. Instead, it just copy-pastes an existing list, like the S&P 500. Here's the kicker: the fees. Since there's no highly paid manager, the expense ratio is dirt cheap. We're talking 0.02%. If you invest $100,000, you might only pay 20 bucks a year in fees. That's less than a couple of lattes. The catch? You don't have real-time control. Index funds are priced only once a day after the closing bell. It's built for the long haul, not for day trading. Mutual funds, the pros. Now, on the flip side, we have mutual funds. These are the active players. When you buy into a mutual fund, you're paying for a captain to steer the ship. You're betting that a professional manager can use their secret sauce to beat the market. But here's the reality check. Talent costs money. Management fees here usually range from 0.5 to 2%. That might not sound like much, but over 30 years, those fees can swallow nearly a third of your total returns. And the most shocking part? Statistics show that over 80% of these pros actually fail to beat a simple, cheap index fund. Hedge funds, the whales next. We've got the big game. Hedge funds. This isn't for the faint of heart. To even get in the door, you usually need to be an accredited investor. That's fancy talk for having a net worth of over $1 million. Hedge funds don't just buy and hold. They use aggressive tactics like short selling and leverage. They use the infamous 2 and 20 fee structure. That's a 2% flat fee, plus they take 20% of your profits. It's high risk, high reward, and highly exclusive. ETFs, the hybrid. Finally, let's talk about the rising star, the ETF, or Exchange Traded Fund. Think of the ETF as a hybrid. It has the DNA of an index fund, but it acts like a stock. The biggest game changer? Flexibility. Unlike an index fund, you can open your app at 10:30 a.m. and sell your ETF instantly. The price moves every second. ETFs are incredibly tax efficient and usually have very low fees. For the modern investor who wants to diversify with one click, but still wants the power to trade whenever they want, ETFs are the absolute sweet spot. The verdict. So let's recap the playbook. 1. If you want the lowest fees, go with index funds. 2. If you want midday flexibility, go with ETFs. 3. If you trust a specific manager, look at mutual funds. And 4. If you're a billionaire, hedge funds are waiting. As Buffett says, don't find the needle, just buy the haystack. Start small, stay consistent, and let compound interest do the heavy lifting. Thanks for hanging out. If this helped, hit that like button. See you in the next one.